Hello, this is Brian Sikorski with Stratos Wealth Partners. Thank you for joining me today. As a wealth advisor, I help clients work toward achieving their financial goals, and I do this by providing them with personal, business, education, insurance, and legacy planning. And I provide access to investment solutions, including stocks, bonds, mutual funds, and exchange-traded funds. Today we're going to cover LPL Financial Research's Outlook 2016, Embrace the Routine. We're going to provide you some insight into the anticipated status of the economy and the markets for the remainder of this year. LPL Research expects routine year-end outcomes in many areas of the economy and financial markets. However, how we get there may be anything but routine. And 2016 will require a solid investment plan to successfully navigate this year. However, by maintaining our investment process, we can focus on what matters most and block out the short-term distractions that we're all confronted with. Some of the key themes to watch are the continued Federal Reserve attempting to tighten their economic cycle or their monetary cycle. So we expect them to continue on their desire to raise interest rates. They've already done so in December of 15 by raising the federal funds rate by a quarter point. We also expect stabilizing oil prices. This should occur in 2016, and we have a bias to the upside as supply and demand continues to move into a more long-term balance. And thirdly, we expect earnings to rebound. We expect some of the headwinds to subside, and these included falling oil prices, a strong U.S. dollar, manufacturing weakness, and a slowing growth in China. So we believe that earnings growth will begin to accelerate. Our expectations for 2.5% to 3% growth in the economy is based on the historical mid-cycle growth rate of the last 50 years and supported by increasing contributions from manufacturing, business capital spending, net exports, and consumer spending. On stocks, we expect returns consistent with mid to late cycle economic performance driven by earnings gains and a largely stable price-to-earnings ratio. However, with bonds, a limited return environment is much more likely and is expected to persist in 2016, and the year as a whole will look similar to last year. However, bonds are still going to play a very important and, in fact, vital role in investors' portfolios, helping them with risk mitigation and diversification. We believe we're likely in the second half of the economic cycle, but 2016 may be the first typical mid-cycle year of the expansion. Planning around potentially increased volatility, rising interest rates, and improving global growth will help investors get back to that routine. So some of the things that we've identified as things to do include emerging market stocks. We have attractive valuations and a likely boost from fiscal and monetary stimulus of those countries. Developed international stocks with improving overseas growth, which will likely boost from more quantitative easing. Bank loans, which are the least sensitive to rising interest rates and may continue to benefit from low defaults and a limited energy sector exposure. And finally, a global macro alternative strategies with current market environment, government and central bank policy divergence with moderate volatility. These should be helpful for these strategies. From a regularly scheduled perspective, meaning things that you should, if essentially maintain in your portfolio, we're looking at things like large cap U.S. stock. These are well positioned for latter part of the business cycle and improved overseas growth. Cyclical growth stocks, which will benefit from ongoing U.S. economic expansion and improving overseas growth. Investment grade and high yield corporate bonds, which have historically held their value better during periods of rising rates, and corporate balance sheets continue to remain healthy. Intermediate term municipal bonds, their longer term valuations are still attractive, and limited growth of overall market may support their prices. We're looking to avoid the distractions of things like U.S. defensive stocks. U.S. defensive stocks will not perform as well with rising interest rates, so there's something to be concerned about. Long-term high-quality bonds with low yields, expensive valuations, and sometimes the sensitivity to rising rates. Developed international bonds, lower yields as compared to the U.S., and currency risks make for an unattractive risk-reward. And small cap stocks, which tend to do better earlier in the business cycle and benefit less from improved global growth. Our view is that the U.S. economy will post growth of 2.5% to 3% in 2016, below the post-World War II average of 3.2%, but above the average growth rate seen in the first 6.5 years of expansion, which is 2 to 2.5%. The manufacturing economy is stabilizing and may be poised to accelerate further. We expect the housing sector and consumer sector to continue adding to growth, benefiting from low energy prices, record levels of household net worth, and still low consumer interest rates. Business capital spending should add to growth in 2016 as commodity prices start to stabilize. Net exports, which were actually a drag on growth last year and the first 3 quarters of 2015, may stabilize as the dollar consolidates after the 20-plus gain between mid-2014 and 15. This matching the largest 12-month increase in the value of the dollar versus its major trading partners since the dollar went off the gold standard in the early 70s. We expect the dollar will begin to stabilize as central bank policies and the outcomes of these policies become a bit more clear. We expect continued progress in the U.S. labor markets in 2016, nudging the unemployment rate closer to that all-elusive full employment rate range, the level at which in the past businesses needed to raise wages to attract and retain skilled workers. Wage growth has been limited but should continue to accelerate in 2016. This wage acceleration, if not accompanied by better economic growth, may cause some headaches for the Fed as it attempts to more normalize its policies. LPL Research's cycle clock compares where we are in the current economic expansion with prior expansions across several important measures of economic activity. The cycle clock highlights different ways of looking at the current expansion and not necessarily meant to be predictive. It suggests, however, that we are in the mid to late stages of the current expansion, but we are still seeking some early cycle behavior and such as looser monetary policy, inflation, and employment growth, and late cycle behavior, items relating to corporate profits. After the Great Recession, governments in both developed and emerging markets increased fiscal stimulus with more government spending, tax cuts, or a combination of the two. As the global economy emerged from the recession, governments have started to rein in, or in some cases reverse, the fiscal stimulus put in place during that time, most notably in the developed markets. And that's what this chart is showing us. Their Great Recession response, and then their status since the end of the Great Recession. Monetary policy is still mostly supportive abroad. Fiscal policy may contribute to growth in 2016. So short-term factors, including oil stabilization, may help exporters. China's neighbors and commodity producers are the most vulnerable to a slowdown to China's growth. Long-term factors include lower debt levels and demographic support of emerging markets in the long term. And this chart is just showing us essentially the GDP of various countries. And we can see that even at 13.3% with China, that's measurably higher than most other countries. So even though they have had a slowdown, it's still anticipated to be moving quite aggressively forward. So we expect China's official growth rate to continue to slow in 2016 to the 6 to 7% range. Concerns over a China slowdown have captured the investors' attention, and we're more focused on the future of China's economy than what occurred in 2014 and 15. And though China needs to be monitored, we view the potential for what's known as a hard landing, defined as a 2% growth for its economy, to be remote. Just as important as the absolute level of growth is the composition of that growth. The Chinese economy is dependent on investment spending, largely driven by the government, even if the entity involved is theoretically a private company. Its large population means that its economic future may be driven by consumer spending, but it will take years before Chinese consumers are able to spend on par with their developed nation counterparts. We believe developed international markets may outperform the U.S. in 2016. Europe in particular is earlier in its recovery than the U.S., suggesting potentially stronger earnings growth overseas, while valuations are relatively more attractive. The dollar strength may reward investors who choose to hedge their currency exposure. And favorable valuations, strong demographic trends, and the potential for stimulus are supportive of growth for emerging market stocks. However, these gains are going to require a tolerance for volatility. Given our view of the economy, we have high confidence that the range of likely potential market outcomes in 2016 will fall into those highlighted in the figure above, characterized as mid-cycle markets. We believe the worst returns are unlikely, as well as the high end, due to unusual circumstances during those years. This leaves a positive 5 to positive 25% as a range of outcomes, with a range of plus 5 to plus 15% as the most likely. Because we expect 2016 GDP growth near its long-term trend, corporate America should get back to delivering solid profits with mid to high single-digit earnings growth, helping to push the stock market higher. Earnings growth in 2016 is expected to be similar with and without energy included, as shown in this figure. At 17.6, as of the end of November 2015, stocks are above their long-term trailing price-earnings ratio of 15.3. Well, they are only slightly above their average since 1980 of 16.4. However, these valuations look more reasonable when put into the context of low interest rates as shown in this figure. Since 1962, the average trailing PE ratio when interest rates are low, below 4% in the 10-year Treasury, is 17.7 versus 8.6 when they are high, such as above 8%, suggesting that stocks may be quite fairly valued. Volatility is a characteristic of the stock market, and pullbacks such as the one experienced in 2015 August are quite normal. Since 1950, the average peak to trough decline for the S&P 500 is 145. Even in positive returning years, the average is 11%. And the index suffered at least a 10% correction in 41% of those positive years. Since 1950, the S&P 500 returns during election years have averaged about 7%. Election years tend to be a difficult time for a divided Congress to pass legislation. However, some issues may influence the market in 2016. Tax reform. Although comprehensive tax reform, particularly corporate tax reform, is unlikely in 2016, targeted measures may be reached given Paul Ryan's election as Speaker of the House. Healthcare reform, with political headline risk perhaps the most acute in healthcare as lawmakers and presidential candidates focus on prescription drug pricing. Regulatory changes are unlikely, potentially creating an opportunity for this healthcare sector. Energy policy. The oil export ban is difficult to be lifted amidst opposition in the White House and among Democratic leaders who believe exports will raise gas prices, and this may delay the pace of the market's supply adjustment. With regards to large cap U.S. stocks, which are on our list of how to invest, as the business cycle matures, large cap, higher quality companies have historically benefited. Overseas exposure may be positive in 2016. Cyclical growth stocks, a continued economic expansion should favor economically sensitive sectors such as industrials and technology. Productivity, we expect the market to reward firms with higher improving margins and strong balance sheets. Energy, the energy sector is poised for a rebound as the gradual oil supply adjustment process continues and demand remains steady. Healthcare, demographic trends, global reach, Affordable Care Act demand, and continued innovation may lead to above-market earnings growth and returns for healthcare stocks. Some routines are more challenging than others, and sticking with bonds may be one of them. A limited return environment is likely to persist in 2016, and the year as a whole may look similar to 2015. High valuations, steady economic growth, and the lingering threat of Fed rate hikes will likely keep pressure on bond prices in 2016. We do not envision a recession developing, which we believe is ultimately needed for a sustained move higher in bond prices. A bond routine should still be maintained and plays a vital role in investors' portfolios despite prospects of low returns. Over the last 12 years, high-quality bonds provided a key buffer during periods of stock market weakness. Specifically, high-quality bonds outperformed stocks by more than 13% on average when the broad stock market declined by 5% or more over a period of 3 or more weeks. While the average absolute return from bonds was low, risk mitigation was still notable. And this shows the total return of bonds as compared to changes in bond yields. Now, high valuations of bonds are one of the challenges that may pressure their prices downward for 2016. Inflation-adjusted yields, one of our key valuation barometers, remains very low by historical comparison. The lower the inflation-adjusted yield, the more expensive bonds are, and vice versa. We believe bonds may remain expensive by historical comparison. However, current valuations have gone a long way to price in weak economic growth as well as a delayed start to the Fed interest rate hikes. Much of the good news is priced in, and absent a recession, upside for high-quality bonds is limited, and we remain cautious. The last time valuations were more expensive than late 2015 levels was in late 2011 and into 2012 in the aftermath of European debt fears and a double-dip recession in Europe. The prospect of Fed rate hikes is another challenge. With the gap between market expectations and Fed forecasts regarding timing of Fed rate hikes have narrowed, but expectations on the pace of rate hikes remain wide and imply a much more gradual pace of rate increases compared to Fed forecasts. So much of the good news about a go-slow approach from the Fed is already priced in and removes a potential upside catalyst to bond gains. We continue to find high-quality municipal bonds attractive due to still cheap valuations relative to treasuries, with most top-quality issues yielding slightly more than comparable maturity treasuries. The relative strength of U.S. treasuries over the second half of 2015 put municipal valuations on a more attractive footing. Bear in mind, municipal bonds will take their cues from the Treasury market, but more attractive valuations can provide a buffer against rising interest rates, in addition to an attractive level of after-tax yields. So the municipal market is on track to post limited overall debt growth in 2015, but any meaningful increase is unlikely. So how do we invest in bonds? Well, first of all, intermediate bonds, particularly high-quality intermediate bonds, offer important diversification benefits and help anchor portfolios. These intermediate-term bonds, rather than short or long-term bonds, offer an appropriate blend of yield for a given amount of interest rate risk. Bank loans are the least sensitive to rising interest rates and may continue to benefit from low defaults and limited energy sector exposure. High-yield bonds offer a substantial yield advantage to U.S. Treasuries. With defaults likely to remain low by historical standards in 2016 and valuations adequately compensating for rising default risks, we find value in high-yield bonds, a sector that has historically offered a buffer against rising interest rates. And municipal valuations improved in late 2015, but remain attractive relative to treasuries on a long-term basis. Taxable equivalent yields remain attractive compared with taxable alternatives, and limited net supply may help to support prices. Since the start of the bull market for stocks began in early 2009, the investing environment has been filled with plenty of distractions, some serious disruptions, and occasional risks of derailment, from the lingering shock of the Great Recession to extraordinary central bank intervention around the world, a debt crisis in Europe, slowing growth in China, falling oil prices, and plenty of political drama. As we progress into the latter half of the business cycle, a good routine will continue to serve as a steady guide as investors work toward their financial goals, but it will become increasingly important for a good routine to be flexible enough to adjust to a changing environment. As we look ahead to 2016, we present some new routines, including those principles we believe investors should continue to rely on, some areas that may require some flexibility, and some important changes we see in the coming year and beyond. International and domestic investments, large and small company stocks, and stocks and bond sectors have all exhibited their own routine in response to Fed rate hikes. In some cases, the same routine to handle Fed rate hikes may serve investors well, but others, changing times may require new routines. We believe divergent central bank policy and improving global growth are two key drivers for improving international stock performance in 2016. Still, we do not expect the disparity of performance witnessed in prior periods, as U.S. economic growth is likely to remain strong relative to many developed counterparts. Large and small company stocks, our large cap bias is fundamentally in response to large cap strengthening over the second half of the business cycle. But resilience during rate tightening also plays a role. We believe the current hike is taking place in an aging economic cycle, and we remain skeptical of a repeat of small and mid-cap strength. We believe technology will prove resilient in the face of rate hikes. Technology returns have varied significantly over rate hike periods, in part due to the late 1990s tech bubble. But we believe valuations, earning potential, and increased corporate spending on technology as companies try to remain competitive may support performance. While stabilizing oil prices may limit the upside of consumer discretionary stocks in 2016, a strengthening job market may provide a lift to the sector's historical trend of underperformance. On the other hand, stabilizing oil prices may help the energy sector start to rebound, although headwinds from the supply overhang may cap out performance. Finally, the financial sector, which is a notable laggard 1 year after rate hikes, may follow a different cycle. Financials are fundamentally stronger heading into this rate hike cycle than in the past and may weather rate hikes better. But the sector still faces some uncertainty if financial regulation continues to limit growth opportunities. More attractive valuations still make corporate bonds, high yield in particular, part of a game plan to play defensive against rising rates. Among high quality bonds, mortgage-backed securities have shown resilience to Fed rate hikes. We expect municipal bonds to fare better during the rate hike cycle, as limited net supply and attractive valuations on a long-term basis may continue to support the sector. For stocks, valuations most commonly measured by the price-earnings ratio, or PE, can have a strong influence on returns over the long term. In general, the lower the PE ratio, the greater the prospective long-term return, and vice versa. The current PE ratio on the S&P 500 index suggests investors may expect average returns in the high single-digit range if the relationship holds, although this is only one factor influencing overall returns. A similar forecast can be done with bonds. While stocks are moderately expensive, bond yields are sitting near historical lows with valuations near historical highs. Over the long term, yield has been the dominant driver of expected returns, although there are other things that can have an impact, such as default levels and changing interest rate environments. Pushing the 10-year Treasury yield out over the next 10 years shows that high-quality bond investors may expect a modest 2% annual return on average over the next 10 years. And the difference between the expected return on stocks and quality bonds is often called the risk premium. It reflects the additional return investors expect for taking on the added riskiness of equities. Looking at a stock's PE and bond yields, while stock return expectations need to be lowered over the next 10 years, so do bond return expectations. And the added return for the added risk of stock remains fair, with a tilt towards an above average premium relative to past history. So in conclusion, we believe the key to success in life and investing is juggling the familiarity of old routines with the need for change that is brought about by an ever-evolving world, market, and life. At the center of this routine is finding the ideal balance between old versus new, habits versus adaptations, and process versus progress. It is likely that 2016 will offer a menu full of items that will require changes to the routine we have grown accustomed to, such as a new U.S. president, Fed rate hikes, and shifts in global growth. Regardless of the changes in the investment landscape, some good habits never fade, including the guidance of a well-formulated investment plan, a portfolio comprised of diversified investment, a long-term focus, and using LPL Research's Outlook 2016, Embrace the Routine, to help identify the thought leadership ideas that may guide you towards success. And with that, I will say thank you very much for joining me. If you have any questions, give me a call at 919-650-1527, and I'll be happy to assist you in any regard. Thanks again, and have a great rest of your day.